Good afternoon, good evening, good morning to every one of you. So I believe everyone would have joined from different part of this world, and accordingly, we welcome you all on behalf of SBI Securities for this webinar on equity markets. So basically, joining us today is Vinayak. So Vinayak is a senior technical analyst in our team, and myself, Sunny. I am heading a fundamental desk at SBI Securities. So today, what we will try to cover in the next 45 to 60 minutes, various aspects on the fundamental side. What is the current structure of the equity markets? Where are the opportunities from medium to long term perspective? Followed by technical and derivative perspective on the equity market. So predominantly, Vinayak will walk us through how is the market set up in terms of charts, what are the various data point indicating to us, and what should the strategy in terms of trading as well as investment. So without much wasting much time, let us start with the presentation. I hope the slides are visible to you. Angelica, if you can put slide. Yeah. So the title of this webinar is Bulls Retired Herd but Not Out. So basically, when we say bulls, we are referring to the bull and bear, which we refer to the in equity markets parlance. And what we mean to say is that although last 4 to 6 months has been very challenging for domestic equity market, and hence we believe that bulls have been retired herd. So after a fabulous rally between FY20 to FY24 period, we have seen last 6 months to be very challenging period. But again, India being one of the fastest growing large economy in the world, the long term growth story of India is still intact. And we believe that this is a temporary passing phase which we need to manage, which we need to survive. And if we are able to survive this challenging phase of next maybe 3 to 4 months, then probably next 2 to 3 years is the time where we can make a decent wealth out of the equity market. So let us see what has happened in the market during the last 3 4 months. So as we all know that yeah, so as we all know that we are going through a very uncertain business environment, and equity market hates uncertainty. So any uncertainty in the global trade or equity market leads to the lot of correction in the market. So let us step back and see what has happened during the last 4 5 months. So if you remember that in the month of September, the news that Trump has won with a thumping majority, and it was backed by the China stimulus and then Japan rate hike scare. So followed by the hawkish stance by the US Fed, and at that point of time, US dollar index was trading at levels of 100. So between the period of October to Feb, we have seen US dollar index appreciating by 8 to 10%. So it went up from 100 level to 108 and 110. Although as of now, as we speak, it has corrected back, and right now it is trading at close to levels of 103 and 104. And at the same time, US 10-year bond yield appreciated by 80 basis point during those periods. So it was at 3.6%, and that expanded to 4.7 to 4.4%. And this was a phase where there was a flight of capital from all the emerging markets. So what happens whenever there is a strengthening of US dollar, we always see that capital flow out of the emerging market and they go back to a safer haven like US bond yield or US dollar. And that led to this entire correction of last 4 to 6 months. And we all know that during the post September 27th, when Indian equity market hit the peak, FIIs have been continuously selling in domestic market. And as we speak, their selling is more than close to 3 lakh crore number, and that's a phenomenal number that we have seen. And during the last 4 to 5 months, we have seen that there has been a lot of changes in terms of the way large economies have positioned themselves in terms of their growth strategy, right? So we all know that post Trump assuming office on 20th of Jan, MAGA, which is Make America Great Again, that's the narrative which he has been pushing. And the various, if you go through the various news and development across the US, you will see that Mr. Trump want US dollar to be weaker so that US as an economy can become more competitive in terms of manufacturing. They can export to the world rather than import. At the same time, he is in favor of lower energy prices. He wants manufacturing to move back to the US. At the same time, he want equal terms on trade in terms through tariff. So we all know that there has been a lot of fight going on between Canada, Mexico, China, and US, wherein the counter tariff, reciprocal tariffs are being imposed and they are being rolled back. But ultimately, I believe that the first week of April is where we will get a lot of clarity in terms of tariff for all the trade partners of US. US is focusing more on US basically shale gas production. So shale gas production is something which US is trying to increase. Renewables has been on the back foot as per the US latest strategy. US is no longer willing to provide security to its allies and is withdrawing from the war. So what has happened is that earlier US was a big daddy, being the largest economy in the world. They used to play a role of moral policing, and they always used to provide support to their allies in terms of security, in terms of arms and ammunition. Right now, US is looking inward, and they don't no longer want to fund the security program for its allies, and they are withdrawing from the war. So at the same time, US is trying to boost its consumption by giving tax cut to corporates or its citizens. And at the same time, Trump has time and again alluded to the fact that this transition can be painful for US. So as per the latest US Fed meeting outcome, we have already seen that the GDP growth forecast has been cut down marginally during the this Fed meeting, and at the same time, the inflation forecast has been increased slightly. And this high inflation forecast is on the back of expected high tariff on the various goods which are coming in the US. So this is the kind of situation where we can say that there will be a stagflation. I mean, when we say stagflation, that is a stagnant growth and high inflationary environment. And this doesn't augur well for US as an economy, where you will see a slowdown in consumption, corporate profitability will come off at least in a over the period of next 2 to 3 quarters. And we believe that this is a perfect setup where the fund will be moving out of the US and will be chasing other growing economies. So as we grow, as we proceed ahead in the presentation, we will see that how money is moving out of US and emerging economies like India and shifting towards cheaper markets like Europe and China. At the same time, if you look at Europe now, so all of a sudden that this was a sudden shock for the Europe that US is no longer going to support their army or security needs, and hence Europe has announced their rearmament program, wherein they are going to spend 1 trillion euro on the defense program, and this will kickstart the economy as far as eurozone or Europe is concerned. In addition to Europe, China, which is again one of the large economy, they are trying to boost their economy by giving an economic booster to various fiscal as well as monetary measures we have seen being announced by the China. Another important development, likely end of Russia and Ukraine war, wherein we will see a rebuilding of Ukraine. So that can again lead to a spend of close to $500 billion to rebuild the Ukraine, and that augurs well for eurozone as well as close by economy. And we all know that gold has been one of the favorite assets during the last 4 to 5 months, and it will act as one of the important reserve for all the central banks. So till date, 6 months back, everyone was holding on US dollar being one of the largest trade currency. But now with US trying to uh, play on a pitch that they would like to keep a dollar on a weaker note. So globally, everyone is trying to, all the central banks are trying to basically diversify their reserve asset, and they are trying to park their money in gold. So it may happen that over the period of next 2 3 months, world may be bracing for changing economic structure. So these are the changes which we have seen as far as the world's largest economies are concerned, and everyone is trying to strategize themselves in a way that they can keep growing their own economy independently from the US, right? So that's the key changes we have seen in the markets. So now let us see what has happened in the market during the last 4 to 6 months. So as you can see from the chart on the topmost chart, that if I the topmost chart indicate the percentage return of the various equity market beginning 1st of April 2024. So you will see that during the last almost 10 to 11 month, Nifty 50 has delivered only 2% return since the 1st of April 2024. And compared to that, Hang Seng, DAX, Shanghai Composite, FTSE 100, S&P 500. So basically, if you look at the overall market structure, so basically Chinese market and European markets have been doing well since the 1st of April. And if you try to plot this statistic from 27th of September, so that stats is in the lower end of the chart. So you will see that the Nifty has corrected from its peak on 27th of September by 12.5%. This correction was to the tune of 15% when market made bottom close to 21,800 levels on 4th of March. And against that, we have seen 24% rally in Shanghai Composite, 20% in Hang Seng, 20% in DAX, and 5% in CAC. So clearly, this show the money is flowing from out of India and US to other markets like Europe and China. So basically, ultimately, it is the money flow which drives the market, and the clear indication is that money is flowing towards the Europe and China at a current juncture. They being trading at a cheaper valuation, they are likely to post a good growth over the period of next 2 3 years, and hence money is chasing those market at a current juncture. Moving on to the next slide, if you see the sectoral performance in domestic equity market, so as we have seen that Nifty is down close to 12.5% as per the yesterday's closing. But if you look at mid cap and small cap, the mid cap 100 is down to the tune of 17%, and small cap 100 is down to the tune of 20%. And when it comes to the sectoral indices, what is the percentage correction from 52-week high? So you will see that most of the sectoral indices have corrected significantly during the from its 52-week high. Whether it is Nifty Media, which is down by 31%, Nifty Energy down by 27%, Realty down by 27%. However, if you come to the bottom end of the chart, you will see that Nifty Bank, Financial Services, they are down only by 9% and 4%. So there is a clear outperformance from Nifty Bank, Nifty Financial Services. So this clearly shows that there is a lot of interest on by the street or institutional investor towards the banking stock and non-banking financial services company. So basically, this clearly shows that there is a relatively strength in the NBFC, or you can say BFSI as a sector. And whenever there is a recovery in the market, this is the first sector which may take a lead in terms of recovery. So in terms of relative positioning, Vinayak will walk us through that, how on a relative basis various indices are placed and which are the indices which are looking good from short to medium term perspective. So when Vinayak will walk us through that on a relative strength as a parameter. Again, if you see, so basically this chart indicate that so this is a universe of NSE 500 stock and how much they have corrected from their respective 52-week high during the last 1 year. So you will see that 80% of the NSE 500 universe have corrected by more than 20%, and that shows that the pain is significant in the a broader market. So entire market has collapsed during the last from its 52-week high, and the pain is significant. So there is no sector or there is no pocket where there is a kind of uh, joy. In fact, we can say that there is a pain across the broader market, and hence it is likely that every one of us would have seen a dent in our portfolio. So that's the current structure of the market. And even if you go in the history, you will see that after every 3 to 4 year of good bull run, we always see a kind of 15 to 20% kind of correction in the equity market, and that's the case. I feel was due for the domestic market, whatever may be the reason. It may be a global or domestic reason, and that's the reason we have seen that there is a correction in the market, right? But having said that, markets have always climbed the wall of worry. So this is a chart where we have plotted the trajectory of basically Sensex over the since 1998. So we have gone through a lot of events since 1998 where Basically, we have seen Kargil war, US twin tower attack, change of government in 2004, wherein BJP lost the election, UPA came into power, 2008 subprime crisis, then a taper tantrum, eurozone crisis, BJP coming back to power in 2014, or for that matter, COVID scare in the calendar year 2020. And at the same time, since post 2020, also post COVID, we have seen again a lot of event which has played out in the market. So whether it is a union budget, privatization of PSU, US Fed Reserve tapering announcement, banking crisis in US. Despite of that, we have seen that market has always climbed the wall of worry and have went on to make a new high. So that's the nature of the market. So wherein whenever there is an uncertainty in the market, there is a short term, and we have seen history has proven time and again that post correction, whenever there is an uncertainty, market will see correction, a steep correction in a shorter period of time. And when this uncertainty is almost clear, there is a clear visibility that the impact of this event is not likely to be very much on any sector or any particular part of the world, and then market again starts to scale a new high. So till the time you Indian corporates are delivering a profitable growth, I believe that markets are in a good shape as far as long term outlook is concerned. Now let us check how are earning growth and valuations looking as far as domestic equity markets are concerned. So this is a chart where we have plotted the sales growth momentum for Nifty 50 universe and since COVID, that is 1Q FY20, and you will see that the momentum post COVID was very good. I mean, if you look at post 3Q FY21, the growth momentum as far as Nifty 50 sales is concerned was in the band of 20-30%, and it started tapering beginning 2Q FY23. And from last of 3 to 4 quarter, sales growth momentum has slightly fizzled out on the higher base. So especially during the last 2 quarters. So if you look at the last three bar on my right hand side, so the from beginning from right hand side, the first bar is 9 month FY25 sales growth, which is 9 month sales growth is hardly 6.5%, and the bar next to that is 3Q FY25, where the sales growth was 5.8%, and the bar next to that is for 2Q FY25, where the sales growth was hardly 5.3%, and prior to that 8.3%. So basically, last 3 quarters has been pretty weak in terms of sales growth momentum, and that's impacting the that has led to the that was driven by predominantly slowdown in the government capex. If you remember, there was a general election in the first quarter during the first quarter of this year, and that led to the delay in decision making, reduction in government capex, inflationary impact on urban consumption, and tightening liquidity conditions. So that led to the slowdown as far as sales growth momentum is concerned. Moving on to the profitable profit growth on a quarterly basis. So the earlier chart was reflecting the sales growth of Nifty 50 company on a quarterly basis. This chart is reflecting profit growth of Nifty 50 companies. So if you see at the profit growth, even the profit growth have hit the speed bump. So if I look at the number 4, which is on the extreme right hand side of my chart, you will see that profit growth has fizzled out significantly. It's a kind of low single digit kind of profit growth during the last 9 months. So during the last 9 months, the profit growth was close to 4% as far as Nifty 50 is concerned. And if you look at 1Q, 2Q, and 3Q profit growth number for Nifty 50 company, that was hardly 2.4%, 1.8%, and 8%. I think there is a request to make the slide full screen, but due to some technical reason, I am unable to make the screen. Just a minute. My apology, I am unable to make this slide on a full screen basis, so we need to bear with this. There seems to be some issue with this StreamYard. We will move on to the next slide now. Yeah. So, as we have seen that quarterly profit growth of the Nifty 50 companies and sales growth was impacted during the last three quarter. And similarly, we have seen that earning downgrade cycle. So basically, if you see this chart, what is this chart reflecting? This chart is reflecting EPS growth estimate by analysts for calendar year 25, 26, and 27. So if you and the dark black color line is indicating the movement of Nifty over the period of last 3 4 years, right? So you will see that since May 2022, there was a continuous upgradation of Nifty 50 EPS by an analyst, and accordingly market were also moving in tandem with that EPS growth estimate, right? And when you come to the extreme right hand side, the second number of the number two dotted line pattern, you will see that beginning the September quarter there was a downgrade as far as the EPS estimate for Nifty 50 companies is concerned, and accordingly post since this downgrade came after the period of last 3 4 years, there was a correction in equity markets also. So this clearly again shows that markets are slaves of earning growth. In case there is a slowdown in earning growth in any equity market, whether it is India, US, or any other market, and at the same time valuations are slightly expensive, you will see the phase of correction, and this again is clearly reflected in Nifty 50 companies. We try to plot the similar number for Nifty Midcap 100 companies, and you will see that the earning downgrade cycle for Nifty Midcap 100 companies was begin slightly earlier. So, if, as seen earlier, we have seen in the earlier slide that for Nifty 50 companies, the earning downgrade cycle begin from September onwards. But for Midcap Universe, this downgrade cycle begin from May 2024, and that was slightly earlier as compared to Nifty 50 companies. But despite of that, Nifty Midcap 100 index kept on moving up till the month of September 2024. So this clearly shows that despite of earning downgrade cycle, which catch up earlier in Nifty Midcap universe, the markets were expecting that the earning downgrade cycle will reverse for Nifty Midcap 100 companies, and it kept on moving up. And hence, when we saw the correction post September, the correction was very steep in Nifty Midcap 100 companies, right? And similarly this chart is for Nifty Small Cap 100 companies also. So this Small Cap 100 universe also followed a pattern similar to Nifty 50 Nifty 50 universe, where we have seen a continuous upgradation of earning till the month of September, and from September quarter onwards we have seen an earning downgrade cycle, and hence correction in the Nifty Small Cap 100 universe also. This is a chart which is reflecting Nifty 50 EPS trajectory beginning 1997. So you will see that if I would like you all to focus on a period between financial year 2002 to financial year 2008, where we have seen that the compounded annual growth rate in Nifty 50 EPS was close to 24%, and that was backed by the global liquidity supported by aggressive growth in China, and that was one of the best phase as far as Indian equity markets are concerned. And post that, we have seen a kind of lackluster earning during FY financial year 2008 to 10. In fact, there was a degrowth as far as Nifty 50 EPS is concerned. And from FY 11 to FY 19, the growth was hardly 4.4% as far as Nifty 50 EPS is concerned. And following that, from FY 20 to 24, that was again one of the second best phase as far as earning growth cycle for Nifty companies are concerned. So you will see that during the FY 20 to 24 period, the Nifty 50 EPS has grown at 22% CAGR, and that is the reason we have seen a very good rally in the Indian equity market. And now from FY 24 to 25, the earning growth is likely to be hardly 5% year over year, and that is the reason we have seen a kind of drop in the momentum as far as equity markets are concerned. And now on a low base of FY 25, we believe that the street is expecting that earning growth will be in the modest 12 to 13% range during FY 26 and FY 27 period. So no need to worry. The slowdown in earning growth is temporary. We believe FY 25 is a kind of temporary blip in the India growth story. And on the low base of FY 25, FY26, which will kickstart just 3 to 4 months down the line, we believe that the earning growth will return back to the double digit, and that will be beneficial for the equity markets as far as sentiments are concerned. So markets are always the slaves of earning. So whenever there is a slowdown in earning, we see a correction in the market, and market expect that earnings should keep on growing at least slightly above the nominal GDP growth rate. So we all know that India's nominal GDP growth rate is likely to be in the band of 10 to 11%. And assuming that Indian corporates, large corporates will at least replicate that growth as far as corporate profitability is concerned, some sector may outperform that growth, and and that is the reason that the street is expecting that a kind of 12 to 13% earning growth is possible in Nifty 50 companies during FY26 and FY27. So moving on to so we have seen the earning growth, what has happened in the earning growth, how there was a pain as far as earning growth during fiscal year 25 is concerned. Now moving on to the valuation. So what we have done, we have tried to plot the valuation of Nifty 50 and Sensex, Nifty mid cap and BSC mid cap, NSC small cap and BSC small cap. So if you look at FY26 column, which is the column FY26 column, so you will see EPS column and price to earning multiple column. So right now the Nifty 50 price to earning multiple is close to 18 to 18.5 to 19 band, which is a kind of uh, 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 average. If you look at the 10-year average of price to earning multiple of Nifty 50 companies, that is close to 20 number. So we are very close, slightly below the 10-year average of Nifty 50p. Similarly, Sensex is also trading close to 19 time price to earning multiple, which is in the fair value band, neither very expensive nor cheap, but at least below the 10-year average. If you look at Nifty mid cap 100 and BSC mid cap, the price to earning multiple is between 25 to 28, and coming to small cap, that is between 21 to 20. So this clearly shows that Nifty and small cap are right now trading at a reasonable valuation band, whereas Nifty mid cap is still slightly above the trading above the Nifty small cap, and trading at premium to Nifty 50 and small cap indices. But if you look at the earning growth CAGR, ultimately, as discussed earlier, the earning growth is one of the important factor. So if you look at earning growth, as discussed earlier, Nifty 50 and Sensex companies are likely to report profit growth of 12 to 13% over next 2 years. Compared to that, Nifty midcap or BSC midcap universe are likely to report earning profit growth of close to 16 to 19%. Since the earning growth is slightly higher in Nifty midcap and BSC midcap indices, we are seeing that valuation are still slightly expensive over there. And the area where we have seen a very steep correction, which is a small cap indices or small cap stock, there the earning growth is still in the band of 13 to 14%. So overall, what I mean to say is that the valuations have at least turned comfortable. They are not very expensive. The froth is out from the market, whether it is in the small cap universe or for that matter large cap universe. However, still mid cap universe is somewhere where we are seeing a slightly expensive valuation, but that is backed by a faster earning growth. So as we were discussing earlier, this chart is showing you 1 year forward price to earning multiple, 1 year forward P chart of Nifty 50 companies. So this is a chart which we have plotted since 1996, and you will see that historically, whenever 1 year forward price to earning multiple of Nifty 50 companies have hit the band of pocket of 24 or 25, we have seen a steep correction in the valuation, and the same was the case this time also. So if you focus on the extreme right hand side of the chart, you will see that the Nifty 50 1 year forward P multiple went up to close to 20 to 23, and now post that now it has come back to the band of 18 to 19 times, which is below the 10-year average of 20 times. So valuations have slightly turned comfortable as far as Nifty 50 companies are concerned. So moving on to the next chart, again this chart shows 1 year forward price to earning multiple of BSC midcap indices. Now why we have chosen BSC midcap indices? Because BSC midcap indices is slightly broader indices where number of stocks are more. So we thought that will be a better representative as far as valuation metric is concerned. So here also you will see that historically BSC midcap indices have always traded at premium to the Nifty 50 companies. And now even there the valuations have gone below the 10-year average of 29 time price to earning multiple. Now equity investing is not about only local market. So global fund manager do look at how the valuations are looking, how valuations are stacking against the various economies across the world, right? So what we have done, we have plotted this price to earning multiple for Nifty as well as other indices, and we have tried to plot on the two different time horizons. So if you look at the blue chart, this was the valuation of various world indices on 27th of September. So 27th of September was the date where we made a lifetime high on Nifty that was close to 26,200 or 300 levels. And then again we have plotted this data on 3rd of March, where we have seen a kind of bottom as far as our equity markets are concerned. And you will see that the valuation premium of Nifty 50 versus Shanghai, which is an representative of China equity market, or MSCI emerging market. So on 27th of September, the premium was close to 74% and 43% versus Shanghai and emerging market, MSCI emerging market. And that has now cooled off to 41% and 29%. So the premium of Nifty 50 as compared to Shanghai has reduced from 74% to 41%, and as compared to MSCI emerging market has reduced from 43% on 27th of September to 29% on 3rd of March, when we again made a bottom this at this point of time. So what I mean to say is that because of the underperformance of the Nifty during the last 6 months and outperformance by the other markets like Shanghai, Hang Seng, the premium of Nifty 50 or Indian equity markets over the other markets have come off, and that's another sign that Indian equity markets have made a kind of temporary bottom as far as the equity markets are concerned, and hence that's a positive development. Now, this was a very short-term picture which we were looking at a current juncture. Basically, now what is the bigger picture of Indian economy and market cap? So what we have done, we have tried to plot a bigger picture. I mean, if I take a view of 5 to 6 years, what is an expectation of Indian economy, and then we have tried to map it with the what can be the possible market cap of domestic equity market over the period of next 5 to 7 years, right? So this is a chart where we have tried to plot the milestone of GDP since independence as far as Indian economy is concerned. And right hand side indicate the market cap milestone. So what was the total market cap at that point of time? So if you see the Indian economy achieved the $1 trillion economy milestone after 59 years of independence in fiscal year 2006, and the market cap, which is the right hand side, the second column, you will see the market cap of Indian equity market was also $1 trillion in 2007. So this shows that the GDP milestone and market cap milestone, they almost move hand in hand. Moving forward 8 years. So if you see in 2014, the Indian GDP achieved the mark of $2 trillion in 2014, and the market cap of Indian equity market was $2 trillion in 2017. So there was a slight delay over here. Sorry. Moving 7 year ahead, you will see that Indian economy achieved mark of $3 trillion in 2021. This includes the COVID shock also. And at the same time, in the same year, we have seen a market cap milestone of $3 trillion as far as Indian equity markets are concerned. And as we speak, the market cap of Indian economy is close to $3.8 trillion, and the GDP of India is close to $3.8 trillion. And if you look at a market cap at a current juncture, that is close to 4.5, $4.7 trillion. So what I mean to say is that there has been a very strong relationship between the GDP number and market cap number of any any economy. And as your GDP keeps on growing, your market cap will reflect that number. Now that number can vary in terms of milestone, in terms of percentage. So historical evidence suggests that the market cap to GDP number can vary between 80% to 130%, depending on the greed and fear and depending on the market sentiment. So ultimately, what I mean to say is that if India is going to be the third largest economy, Right now we are at $3.8 trillion. Assuming a nominal GDP growth of 10 to 11%, we can achieve a milestone of $7 trillion in maybe fiscal year 2030 or 2031, and that can be a positive as far as the long-term picture of Indian equity markets are concerned. So, as we were discussing in the earlier slide, so this chart, what we have done, that we have assumed that the GDP of India is $3.8 trillion in fiscal year 24, and assuming that the nominal GDP growth rate of 10%, 11%, and 12%, what can be the GDP number over the period of next of 4 to 5 years? So you will see that India will achieve a close to $7 to $8 trillion economy size in FY 30 and 31. So what we have done, FY 24 10% GDP growth assumption. It will take 7 years to hit the mark of $7 trillion. Whereas if the GDP is economy is growing at 11 to 12%, we may achieve the mark of $7 trillion in the span of next 6 years. So basically, what this means is that we have added a GDP of $3.8 trillion post independence in the last 75 years, and this entire $3.8 trillion of GDP will be again added back in the next 6 to 7 years. So that's a very big expansion as far as economic activity is concerned. So it took us 75 years to reach $3.8 trillion mark, and from $3.8 trillion to $7 trillion mark, it will take hardly 6 to 7 years. So that's a huge addition of GDP, and that will create a lot of opportunity in many new sectors, existing sector. So what I mean to say is that Indian economy, the long-term growth story of India is still intact, and as discussed earlier, the way market cap to GDP number keep on moving hand in hand, we can expect that the Indian equity market cap can be close to $7 to $8 trillion over the period of next 5 to 6 years. And the current market cap of Indian equity market is close to 4.5, $4.6 trillion number. And if I extrapolate this to the $8 trillion number, then what we can see is that the the CAGR growth of Indian equity market can be in the between 10 to 12%. So when I say 10 to 12%, don't get upset that the return can be so subpar. 10 to 12% is for overall market, right? Now, if you are smart enough, if your positioning is right, and if you are in a favor, if you are positioned in such a way that the sectors which are likely to report a good growth, then you can achieve a compounded annual growth rate of 15 to 20% or 15 to 18% also. So it's all about positioning. So what I mean to say is that larger picture, the long-term growth story of Indian economy is intact. And if I link that Indian growth story to the market cap number, even that paints a very bright picture from a long-term perspective. Now, moving on to the next slide, where what we have done, we have run various screener to identify the future winners from a medium to long term perspective. So, what I wanted to share this few of our the screener with you. So, what we do usually during the downturn in the market, we see a lot of promoter activity happening in the Indian in the market, and the same has been the case this time. So, during the month of Jan and Feb, we have seen a lot of promoters coming in the market and buying their own share from the open market, and that's one of the biggest indicator that the promoter, who is the smartest investor on the street, he is finding value in his own company. He is finding the valuations to be very attractive. He is finding the value of the company to be at discount to the fair value, and that is the reason he is putting his money in his own company, right? So we have made the entire list of the companies where there is an insider trading which is happening, where the promoters are buying and selling, and even we have started including this in our weekly report, weekly wrap. So if you go through our weekly wrap report, which is available on SBI Securities website or Telegram channel, you will find one section that during the last week, which are the companies where promoters are buying their own share, right? Another important screener which we track at our end is the list of the companies which has been consistently growing quarter on quarter during the last 4 to 6 quarter. So that's another important parameter which we track at our end. And obviously, from a short-term perspective, we track the companies which are performing very well, which have performed very well during the recently concluded quarter, that is 3Q. And last and not the least, the companies where FII and DII both are increasing stake. So these are the few screener which we usually track at our end, and I will request you all to also follow this data to make your decision to for you to be aligned in line with the market market positioning, and you can accordingly plan your strategy in terms of your portfolio. So what I will do, I would not like to run through each and every slide. So this slides or this presentation, we can share it with you also if you want this data, and later on your request we can share this data also. So as we were discussing, these are the few companies where promoters have been buying during the last Jan and Feb month. So that's a long list. Then in addition to promoter, we have curated list of companies where key management personnel, apart from promoter, the KMP of the companies have been buying from the market. Then this is a list of companies where there is an increase in FII and DII holding during the last 1 year. Then this is a list of companies which have performed very well during the last concluded quarter, that is 3Q FY25. Then these are the companies where we have seen expansion and EBITDA margin during the last concluded quarter. And then these are the list of companies which have been reporting consistent earning growth during the last 4 quarters. I know it's not visible; the numbers are not visible. So what if somebody wants this data, we can definitely share this data with you all. Now moving on to the most exciting part of this webinar, that which are the sectors which are likely to do well as per our study and analysis. So these are the list of sector which we believe are likely to do well. So the foremost sector which we like is BFSI, as we have seen that this sector has been relatively outperforming the market. So during the correction phase, we have not seen much correction in the BFSI stock, and we believe that on the path of recovery, non-banking financial services (NBFC) as a sector is likely to do well. What the reason behind that is that RBI has already corrected has reduced the interest rate by 25 basis points in the month of April. When there is an RBI policy due, there is a likelihood that RBI may further cut the interest rate by 25 basis points. And overall, over the period of next 9 to 12 months, the interest rate in the economy may be slashed by 25 to 100 basis points. And the clear-cut beneficiary of this interest rate cut is non-banking financial services company. So companies which are catering to housing loan, companies which are catering to vehicle loan, companies which are catering to gold loan, or for that matter SME. So NBFCs as an pack, we feel will be one of the key beneficiary in terms of earning growth, in terms of low cost of fund. So NBFC is the one sector which we believe can do well in the short to medium term. Followed by banking. So in banking, what happens is that usually for a banking as a sector, you will see that whenever there is an interest rate cut, for the next 1 or 2 quarters, there is a reduction in margins of the banking as a sector. The reason being that at one end, your loans are linked to the repo rate. So in case repo rates are coming down, you need to reduce the loan rate you are charging to your customer, which is linked to the repo rate. On the other hand, your FDs, which you have already accepted the money from your depositor, they are already at a higher rate. So deposit repricing happen at a later date. So during this phase of 1 or 2 quarters, there may be a slight impact as far as margin, which is known as net interest margin for banks. So maybe banks may face some profitability issue over the period of next 1 or 2 quarters. But at the same time, with the lower 10-year bond yield, we may see a slightly increase in treasury profits, right? So to that extent, it may offset the losses or the reduction in profit as far as compression in NIM margin is concerned. But overall, banking as a sector, because of valuation, is also looking attractive. So within BFSI, NBFC, and banking, these are the two top pick. And the third sector which we like within the BFSI space is asset management companies. So if you see asset management companies, despite of the weak market sentiment, the inflow through SIP route is still intact, although it has reduced on a month-on-month basis. But what we believe is that ultimately, if I take a longer-term picture, the AUM growth in the band of 12 to 13% is almost taken for the granted, and we believe that asset management companies can also be one of the sector which can deliver a healthy return in case market stabilizes from here on. So BFSI is our topic. The second sector which we like is auto and auto ancillary, but within auto and auto ancillary, we are selectively bullish. So if I look at auto OEM, we are bullish on tractor as a theme. So which are the companies which are in the tractor segment? Mahindra and Mahindra again doing phenomenally well. Escort seems that we can make a decent return over there. Swaraj engine, which is supplying an engine to a Swaraj brand of tractor by Mahindra and Mahindra. At the same time, few auto ancillary name which are technology agnostic. When I say technology agnostic, what I mean to say is that uh, you are catering to you are providing such a product that it is irrelevant whether the end vehicle is using EV as a technology or IC engine as a technology, right? A case in point, Lumax Auto. So their portfolio is slightly immune to it's a technology agnostic portfolio, or for that matter, SJS Enterprises, or for that matter, uh, uh, RK Forging. So we believe that ultimately there are few auto ancillary companies which are likely to do well. Uno Minda is the one company which we like. Third sector which we like is travel and tourism. So India, despite of global slowdown or global uncertainty, travel and tourism is more of an domestic consumption story. And as we have seen post COVID, there has been an consistent growth as far as the average room rate is concerned. So all the hotel companies are enjoying benefit of that. So there are many travel and tourism related stocks, especially on the hotel side, that continue to do well. And another sector which we like, which has not been doing well since last 2 years, is cement, metals, and chemicals. So these are the three sectors which has been kind of underperformer during the last 2 3 years. So we will discuss each sector one by one. So cement is the one sector which we feel is that where the profitability is at 2 year low. So if you look at EBITDA per ton, which cement companies has been making a 2 year back, that was in the band of 1,000 rupees to 1,400 rupees, and that has now reduced to 500 to 600 rupees. So what we believe is that sector, the pain in the sector is already through, and hence over the period of next 2 years, we may see an increase in profitability for the cement as a sector. So if somebody is looking at the sector, one can look at stocks like from a large cap like Shri Cement, Ultratech, and Ambuja. And among the mid cap name stocks like JK Lakshmi, JK Cement, Star Cement. So these are the few stocks which we like among the cement. Metal, again, it's the global cyclical. The metal, so if there is a slowdown in US, and that can have some impact on the metal as a sector. But what I feel is that ultimately it is the China which drive the demand of the metal. And in case there is a revival in Chinese economy, the metal can do well. But again, that's a very volatile sector. So if somebody is trading in a metal counter, one should keep a stop losses also. So overall, metal and metal product as a sector which we is a sector which we like. Chemicals, although again it's a global cyclical going through dumping from China, but select chemical companies which are linked to basically EV, battery chemical, or air conditioning related theme. So those are the few chemical companies which we like. And among the other few sectors like telecom, obviously Bharti Airtel recently clocked its 52-week high last week. Healthcare, hospital as a sector is doing well, whether it is companies like Narayana Rudhalay, Max Healthcare. And at the same time, what I believe is that capital goods as a sector where there was a very significant froth on valuation front. So valuation has come off significantly in a cap goods as a sector. So few companies like Schaeffler India, or the for that matter Thermax, because we have seen a revival in government capex, and that can augur well for that sector. And then few micro sectors where there is a push from the government, such as recycling, right? So recycling as a theme is a theme where government is giving push to the companies that you should be recycling more products. So companies like Gravita, or for that matter JG Chemical. So these are the few companies which we like. So overall, what I mean to say is that going forward, markets are likely to be bottoms up rather than top down. So you need to identify the companies which are likely to deliver a healthy earning growth over the period of next 2 to 3 years. So earlier it was a top down market. When I say top down, you select the sector and all the stocks are doing well. Now when I say bottom up, you need to select the companies which are likely to do well in terms of profit growth, and hence ultimately the companies, irrespective of whether the sector is doing well or not, in case the company is able to deliver a profitable growth, those companies will find buyer at lower levels also. So it's a more of a bottom up stock specific approach henceforth. So what we have done, we have shared the detail about each and every sector in this. So I will not go through each and every slide. We will share this presentation with you, so you all can go through it at your leisure, as per your convenience, right? So I will skip this section. We have already discussed this. At the same time, I mean, equity market is not a risk free, right? So ultimately equity, there is a sector specific risk, and as well as there is a macro level risk. So we have covered this also for each and every sector. So IT sector, just I would like to share my view also here. So you all have been hearing that there is a clamor of slowdown as far as US economy is concerned, and that is the reason we have seen that IT stocks have corrected during the last 20 to 30 days, wherein all the large cap companies have corrected by 15-20%. And obviously, in case there is a slowdown in US economy, obviously, so most of the companies like TCS, Infosys, they derive 40 to 50% of their revenue from BFSI sector and those companies which are based out of North America. So to that extent, I believe that negativity is already in the price as far as IT sector is concerned. For IT sector, it is better to wait for next 15 to 20 days, hear out the management commentary. So we all know result season will kick off from 10th of April. And let us hear from the horse's mouth that what is the demand environment in US, how are they looking at demand in case there is a downgrade in guidance for IT companies. So I would like to stay away from IT sector for next 2-3 weeks, listen to the management, and then take call on as far as IT sector is concerned. So there is one question on FMCG also. So I would like to address at the current juncture only. So again, FMCG as a sector, what I feel is that street is moving from neutral to marginal positive on FMCG sector. The reason being that rural economy is doing well as far as India is concerned. At the same time, the tax cut boost which has been announced by Honorable Finance Minister, so the benefit of that will start flowing from the month of April. And you all know that the booster is in terms of value is close to 1 lakh crore number. That is the 1 trillion rupee number. But if you take a multiplier effect, that effect can be 4 to 5 trillion rupees. That's a 4 to 5 lakh crore number. And there is a probability that few FMCG staple companies can do well henceforth. So amongst FMCG, again, we are very selectively bullish. So we like company like Imami. So we have also initiated call on Imami. Imami as a company on valuation front is looking very attractive, and few more names like Marico for that matter. But again, the return expectation has to be very moderate as far as FMCG as an universe is concerned. Within FMCG, QSR as a segment is likely to do well. So we may find that few QSR company, in case there is a revival in urban consumption, are likely to do well. So, I mean, I would like to take a pause now, and I would like to hand over the floor to Vinayak to let us hear Vinayak in terms of how technical setup, what are the various data pointing to in terms of market outlook from a short to medium term perspective. Over to you, Vinayak.
Yeah, yeah. Thank you, Sari sir. Hope I'm audible to all of you.
Yes, Vinayak, you are audible.
Yeah. Good afternoon, friends. My name is Vinayak. I am a technical research analyst at SBI Securities, and today I will give you a technical insight on a benchmark indices and key sectors for the short terms. As the Sunny sir said, that the going forward market is likely to be a stock specific. Hence at the end of this session, I will give you the interesting piece of information where you can you get the mechanism to how to select the stocks in any market condition. So let's start. Uh, ne- let's start with the global indicators. So which is the things that most of the fund manager tracks. This slide gives us the idea of how the current market environment is for emerging markets like India. So if we see the US 10-year bond yield chart, it has cooled off after marking the high of 4.8%, and currently it is trading below its a short-term and long-term moving averages, which is a bearish sign. And further, if we see the US dollar index, in the month of October, when the Nifty has marked the fresh all-time high, the US dollar index has formed a brace around 100 level, and thereafter, just before US election, it has started moving higher. and this led to the strong outflow in the from a foreign investor in the emerging markets like India. So, however, if we see recently, it has witnessed sharp correction after testing the high of 110, and this correction in US dollar index and 10-year bond yield indicates that the US dollar has weakened significantly in last couple of weeks, and which creates the environment for risk on environment in the emerging markets like India. And that we have seen that FII has started buying activity in the last couple of trading session, and we can see the on Nifty chart also we can see the breakout. So hence believe considering these factors, we believe that the Nifty is likely to continue its outperformance in the short term. The Brent oil has also witnessed marking the sequence of lower top, lower bottoms on its daily scale, and which is a bearish sign for Brent oil, and it is positive for the oil importing nations like India. So moving to the next slide. Next slide. If we see the comparative chart of global indices, the Hang Seng was the strongly outperform global indices in last 12 months, which is surged by approximately 41%. And after the Hang Seng, Euro Stocks 50, which is the basket of 50 stocks from 11 countries from Eurozone, this was the second outperforming sector in outperforming global index. That means that the China and European market has strongly outperformed global market in last 12 months. However, if we see the recent action, I have marked in a black circle that the recently the Hang Seng has witnessed a correction from its higher level, and at the same time, our benchmark index Nifty has witnessed a strong rebound. This indicates that our market has started outperforming the majority of global indices since last couple of trading sessions. Moving to the next slide. If we see the sectoral performance of our indices, the Nifty Pharma and Nifty Metal were the best performing sectors in last 12 months. We recommend to always prefer to do short term and momentum trading in the outperforming sector where the probability of success is much higher. Going forward to the Nifty, if we as we have discussed, since majority of global factors are favorable for our Indian market. Now if we see the Nifty chart from the recent low of 21,964 level, the benchmark index Nifty has witnessed a sharp pullback rally of over 1400 points, or around 6% in just 13 trading sessions. And along with this rise, the index has surged above its 20 and 50-day moving average, exponential moving average, and currently it is trading near its 100 and 200-day EMA level, which is a bullish sign. The momentum indicators are also suggesting the strong bullish momentum in Nifty, as the daily RSI. If you see the daily RSI, it is trading above 60 levels, and it is in a rising trajectory. So considering these technical factors, we believe that in the short term, Nifty is likely to continue its upward journey and likely to test the level of 23,800 in the short term. On the downside, the zone of 23,100, 23,000 is likely to provide the cushion in case of any immediate decline. Coming to the Bank Nifty, if you see the banking benchmark index, Bank Nifty, it has recently took support near its prior swing low, and thereafter witnessed a sharp rebound. Along with this sharp rebound, it has surged above its crucial moving averages, which is a bullish sign. And if we see the momentum indicators, they are also suggesting a strong momentum in the banking space. So we believe and if you see the chart, the index has formed double bottom pattern, and if it is surged above yesterday's high, the index is likely to witness a sharp upside rally, and it is likely to test the level of 52,000 in the short term, as per the major rule of double bottom pattern. So coming to the which sectors are likely to outperform in the short term, we believe that the Nifty Financial Services, if we see the chart, Nifty Financial Services has been already outperforming frontline indices since last couple of trading sessions, couple of weeks. It has formed a symmetrical triangle pattern, and recently it has given a breakout. And currently it is on a verge of giving a downward sloping trendline breakout. So if it is sustains above its current yesterday's high, it is likely to witness a sharp upside rally of nearly 5 to 6% in the short term. Next slide. After the Nifty Financial Services, if we see the chart of Nifty Private Bank, it has given a symmetrical triangle breakout on a daily chart, which is a bullish sign. And as per the major rule of symmetrical triangle pattern, the Nifty Private Bank sector is likely to test the level of 26,100 in the short term. So if we see these two sectors are Nifty Financial Services and Nifty Private Bank is holding highest weightage in our frontline index Nifty. So hence we believe that these sectors are likely to help market to sustain at current level, and in fact move higher from current levels. So now we will discuss how to select the stock in any market condition. Next slide, please. Yes, thank you. So by using relative strength analysis, we can select the stock in any market condition. So what is the relative strength analysis? It is the financial analysis tool which used to compare the performance of any stock as compared to benchmark index. This analysis helps us to identify which sector is performing better and which is performing worse than the benchmark index. The major goal of this analysis is buy high and sell at even higher levels. And this analysis is also known as a ratio chart analysis. So we'll discuss the ratio chart. Next slide, please. Yeah, thank you. The ratio chart, the formula for a ratio chart is very simple. It's security A divided by security B. Here is the denominator is our index. In the denominator we have to use benchmark. For example, if we want to check the ratio chart of Reliance as compared to Nifty, then we have to calculate it Reliance divided by Nifty. The output will be give us how Reliance is performing as compared to Nifty. For this calculation, we generally use the closing price of stock and indices. The output of this formula is the line chart, which we can easily plot in trading view. And by this using this formula, we can compare the stock with index with index, or stock with stock. That means index with index means Nifty IT divided by Nifty. That will give us the idea about how Nifty IT is performing as compared to Nifty. If we want to know how the Reliance and TCS is performing as compared to, then we have to plot the Reliance divided by TCS. So you will get more clarity on this when we discuss practical examples. So how to identify exactly the outperforming sector and stocks. So for that, it's a very simple. First, you have to plot the ratio chart of all the asset classes. Then you have to select the which asset class is outperforming. Thereafter, you have to select which sector is outperforming, and then we'll select the which stock is outperforming. So in that case, your profitability will increase significantly if we use this strategy. So I will give you the few examples. If you see the current chart, if you see the chart, it's a Nifty and gold XAU USD gold chart. In the month of October, the Nifty has started with mark all-time high, and thereafter it has witnessed sharp correction. And during the same period, Nifty gold has witnessed strong upside rally and strongly outperform. If we see the ratio chart, please next slide, please. Yeah, see, this is the ratio chart of Nifty divided by gold. If we see since the month of October, the gold prices have started outperforming, and since in the month of January we have seen the breakout in gold ratio chart, and thereafter we have seen a strong upward rally in the gold prices. During this phase, the equity market has not given a positive returns. So ideally, you should be invested in a gold during this phase. Now, if we see the recent action of this ratio chart, it has formed ascending wedge pattern. It has formed ascending wedge pattern, and yesterday it has given a breakdown. So this ratio chart is indicating that considering this current chart structure, it is indicating that Indian market is likely to outperform in the short term. So next slide. So we got the idea that the equity market is likely to outperform. So in equity market, which sector is likely to outperform? So that we have to compare it with the all the sectors with benchmark index Nifty. So now I have chosen Nifty Financial Services versus Nifty. Now if we see the comparison chart in the month of February, Nifty witnessed a sharp correction. And during the same period, Nifty Financial Services has witnessed a minor correction, and thereafter it has slid into the period of consolidation. That the portion is I have highlighted in a circle. So further, if that is the slow minor correction is also indicating that the Nifty Financial Services is outperforming. And if you see the further recent price action, the Nifty Financial Services has witnessed a sharp upside rally in comparison with Nifty. So this clearly indicates that the Nifty Financial Services is strongly outperforming, and hence you should be invested in this sector. If we see the ratio chart of this both sectors, Nifty divided by Nifty Financial divided by Nifty. Next slide. We can see that in the month of January, it has given a consolidation breakout, and thereafter it has started outperforming. So next slide, please. So we have got the clear idea that the Nifty is outperforming, and among the Nifty Indian benchmark indices, Nifty Financial Services is strongly outperforming. So now we'll check which stock is outperforming from the Nifty Financial Services. So if we see the chart, in the month of December, Nifty Financial Services has witnessed a sharp correction. And during this same period, the stock of Bajaj Finance has witnessed a strong rebound. This is the Bajaj Finance is the part of Nifty Financial Services. Despite of correction in his benchmark index, it has witnessed a sharp rebound. So this clearly shows that the stock is outperforming. And if we see the ratio chart, and ratio chart has also given a clear idea that if in the month of early January, it has given a consolidation breakout, and thereafter started witnessing strong outperformance. So this clearly gives the idea that how which sector is outperforming, which stock is outperforming, and which asset class is outperforming. So by using the ratio chart, we can also identify which sector we should avoid, which sector is likely to go into the underperformance. If we see the current charts, there are the charts of Nifty and Nifty IT. In the recent period, Nifty has witnessed a sharp rebound from lower level, and during the same period, Nifty IT has slid into the period of consolidation. And the major trend of Nifty has reversed significantly, but the Nifty IT is still in a downtrend. So this clearly indicates that the Nifty IT is strongly underperforming the frontline indices. If you see the ratio chart of this sector, Nifty IT divided by Nifty, it has given a head and shoulder patterns breakdown, and it has started moving lower. So ratio chart is also clearly indicating that the Nifty IT is strongly underperforming. So hence we recommend to avoid the Nifty IT space for now, as per the ratio chart. So by using this ratio chart analysis, we can identify the sectors and stocks in the any market condition. So that's it from my end. Now we'll begin the question and answer.
So Vinayak, we will I would like to conclude this overall session as of now. So the key important event to track going forward will be the trade war development, tariff development. So we all know that basically in the month of April, that is in the first week of April, we will get to see the various tariff which US is likely to impose on different countries, and various countries, different sectors are from various countries are likely to get impacted from if I talk from an India perspective, the sectors where India has got a very high tariff on US import is basically automobile. If you look at some agri products, if you look at gem and jewelry, so these are the top two three sectors where India's tariff is relatively very high as compared to what US imposes tariff on India's export to US. So these are the few sectors where we may see some impact in short to medium term. However, the impact will be very high for countries like China, Mexico, and Canada, which are the large trading partner of US. So India, on a relative basis, is a very small trading partner. So if you look at the last year data, the trade deficit with US was hardly $45 billion, and that's not a very big number in the overall US scheme of things. So I believe that there can be some relaxation on tariff as far as auto sector is concerned. So import of vehicles can become cheaper. So that's an important development, and that's one of the big uncertain event for the entire world market as far as this tariff is concerned. Now, what we believe is that if somebody want to deploy a fresh capital in the equity market, then what one can do is that one can deploy the capital gradually over the period of next 3 to 4 months. The recent recovery, there is a possibility that maybe Vinayak can add few lines on that. That the recent recovery can have some pullback also. There is no clear cut signal that markets have seen the bottom already is in place. There is a probability that we may see one more round of correction, not immediately, maybe in the month of April. So still there is a lot of uncertainty. So in case you are planning to deploy any fresh capital in the market, it is advisable that you deploy gradually over the period of next 3 to 4 months. So what is important is that the survival in this uncertain environment. So maybe if you are able to survive this market uncertain time over the period of next 3 to 9 months, in fact, the entire calendar year 2025, if you are able to survive and are able to protect your capital, judiciously use your capital to deploy in equity market, then I am sure that FY26 or calendar year 26 and 27 is the time where we will see a very good return from an equity market. So let this uncertain environment be behind us, and it will take some time for that, because the moment you impose the tariff, you won't see the impact immediately, right, on the all the economic parameter. So it will take 2 3 months for those the parameter to evolve, which are the sectors which are getting impacted because of that. So there will be a lot of uncertainty in the market. In terms of earning growth, so April, May quarter is the quarter where we believe that, as we have seen that there was an earning downgrade cycle which begin from the September quarter, that continued in the December quarter, and there is a likelihood that few companies again may see a slight earning cut as far as April and in the month of April and May, and from first quarter of FY26, that is from the beginning of June, July, we may see kind of earning upgrade cycle, or at least sideways movement in terms of earning estimate. So basically, tracking the earning, what is happening in the various sectors, what is happening in the various category of stock. Just a hypothetical example, it may happen that large cap companies may not surprise negatively on the earning front, but there can be a negative surprise from any small cap or mid cap companies, right? In that case, what will happen? The positioning of market will further shift from small cap, mid cap towards the large cap. So ultimately, post this upcoming earning result season, we may see some change in positioning as far as the smart investors are concerned. We have already seen that money is moving out of SME companies, micro cap companies, or companies where there was just a narrative without any sound fundamentals. So money is moving out of that. You would have seen that many of the stocks have corrected by 50, 60, 70%, and there is no breathing space over there. So that clearly shows that money is moving from high risk asset to a defensive sector, or a certain part of the market which are relatively safe. So this pattern will emerge clearly over the period of April and May month, right? So again, at a current juncture, what we are advising is that one should be focusing on large cap companies rather than a very small micro cap company. So large cap companies offer a better risk reward ratio at a current juncture. Leverage trading, I mean, in case you are doing a leverage trading, kindly do it judiciously. Kindly maintain your stop losses. So, of late, we have been hearing many narrative from the client that आपने बोला था ये company बहुत अच्छी है, but still it is going down. One has to keep in mind that it may happen that the company fundamental may be very sound, but ultimately markets are driven by liquidity, by the money, right? If somebody want to sell that share or some basket of share, despite of the company being good, because of the selling pressure, the stock can correct significantly in a shorter time frame. But and in case you are leverage at that point of time, you may be forced to square off your trade. During the recovery, those stocks will be the first to recover quickly. So ultimately what happens is that in the leverage trade, one need to adhere to the stop losses, despite of company being a top class company from the from his sector or from that respective category, right? So ultimately, one should temper down the return expectation. So one can expect that if I take a very broader return kind of thing, this is a year where one can expect a moderate return of 10 to 12, 13%. Let us survive in this market. The world is going through a lot of uncertain time. Better to keep on booking profits also. So there will be some small phase of recovery, as we have seen during the last week. There was a swift recovery in the market. So it's not it's better to keep on booking profit and not get greedy that I will keep on making 15, 20, 30% return over the span of next 1 or 2 months. So better to stick to a trailing stop loss strategy in case you are on a leverage trade, or in case you have built a new position in the market. So overall, it's the time to be defensive rather than aggressive over the period of next 3-4 months. Let us survive this uncertain environment, and I'm sure the future is very bright as far as Indian equity markets are concerned. If I take the calendar year 26 and 27, one has to keep in mind that this correction is after the very strong, humongous rally we have seen in the market from FY20 to 24 period. So we have seen money sloshing around. Everyone has made a very good wealth in equity market between FY20 to 24, and now this is the part of correction. So every 3-4 year you see 15-20% kind of correction in the market, and this is that phase. In terms of time, so we have already spent close to 6 months as far as this correction is concerned. It may happen that we may spend 2-3 months in terms of time wise correction, sideways movement, volatile movement. But mid cap and small cap historical data suggests that there is a possibility that a mid cap and small cap correction can extend slightly over a longer period of time. So the correction, it may happen that price wise correction would have already been factored in, but time wise correction is just one of the possibility which can happen in the market. So yeah, that's I would like to now stop over here, and now we will try to address few questions which we are seeing in a chat comment box. And I mean, before proceeding for this Q&A session, I would like to apologize that due to some technical reason, we were not able to run this presentation in slide mode or presentation mode. Apologies for that, and we will share this presentation with your relationship manager, and those relationship manager can share it across to you. So you can read this presentation at your will and as per your convenience. And apologies again in case you are not able to visualize this slide. But again, let us move on to the Q&A session.
Yeah, Prasad is asking that what is your projection in gold? Will it go down? So Prasad, I will like to share the trend of gold. If we see, the gold is in a strong uptrend. Recently, it has marked the high of $3,057, and thereafter witnessed a minor correction. If we see the technical chart, the gold prices is a strong uptrend. But if we see, it has witnessed a sharp upside rally. Due to this, the majority of momentum indicators are in overbought condition on weekly scale as well as daily scale. So I am expecting that the gold prices are likely to slide into the period of consolidation for the next couple of trading sessions. Thereafter, they again resume its upward journey.
So there is one question.
Yeah, please go ahead, sir.
Yeah, so there is one question from Sanjay Kumar ji. What is BFSI? Can you please elaborate? When we say BFSI stands for Banking and Financial Services Industry. So BFSI is basically the entire universe which is linked to financial services, whether and it encompasses banking sector, it encompasses NBFC, it encompasses capital market stories, it encompasses insurance as an industry. So the when anything which is linked to the banking and financial services is known as BFSI as a sector. Next question is from Mr. Varghese. When do you think hotel industry will reverse its cycle? So again, a very good question. So what is happening right now is that the demand is slightly ahead of supply as far as hotel industry is concerned, and that is leading to a very healthy traction in terms of average room rate or occupancy of hotel industry. And what is happening because of this last 3 4 year good equity market environment, most of the hotel companies have raised funds through equities and they have deleveraged their balance sheet. So on one hand, their balance sheet is pretty robust in this industry. On the second hand, since demand is outstripping supply, and we believe that as per the various management commentary, as per the various industry expert, this cycle is likely to continue for next 2 to 3 years at least, where demand is outpacing the supply. And that's the reason we believe that this cycle will continue. But again, one has to keep in mind that the frontline companies like Indian Hotel, or for that matter, have already delivered a very good set of return. So now, henceforth, if somebody is looking for better alpha in hotel and sector, so few turnaround stories or mid-market hotel companies like Sami Hotel, for that matter, EIH again, which is a kind of frontline chalet hotel. So the story of operating as well as financial deleveraging has to be picked up going forward. But if somebody is looking for moderate risk and moderate return, then one should stick to a large cap companies like Indian Hotel. So next question is from Prasad Arumugam. Thanks for asking the question. So sir, you have asked the two questions. What about FMCG and what about InvIT like PG InvIT? So FMCG, I think I have addressed that question while we were going through the presentation. So FMCG as a sector again is going through pain. So if you step back little a few quarter back, few quarter back, you will see that most of the companies were telling that rural sector is under stress, urban is doing well. And now, since last 2 quarter, the tone has changed, wherein rural is doing well, but urban is under pressure in terms of demand environment. But what we believe is that because of this recent consumption boost given in the form of tax cut by the honorable finance minister, I am sure that urban as a pocket, which is more relying on salary as the a primary source of income, there we may see more income in the hands of the consumer. At the same time, we have seen recently that the salaries of the government employee has increased because of the increase in dearness allowance and so on and so forth. So we expect that even the urban consumption should revive going forward. And at the same time, with the reduction in interest rate, there will be further savings on EMI. So we believe that the FMCG as a sector is likely to do well over the period of next 2 years. But again, we would like to be very selective in FMCG as a staple as a sector. So within FMCG staple, as discussed earlier, Imami is the one stock which we like. Tata Consumer is another company which we are bullish on. So Marico is another company where we would like to bet money on. Recently, we have seen some correction in the palm oil prices. So that augurs well for soap manufacturer like Godrej Consumer. So these are the few companies where we would like to bet our money on. But one has to keep in mind that this sector, that the growth is very limited to a high single digit or low double digit. When I say the growth is hardly in the band of 8 to 12% as far as this sector is concerned. So don't expect a very runaway rally in FMCG. A moderate expectation, return expectation of 8 to 12% in a short term, either maybe over the period of next 6 to 12 months, is a decent or fair expectation as far as FMCG is concerned. Coming to InvIT like PG InvIT, so one has to keep in mind that InvIT or REIT as a product is a quasi equity product. So it is neither equity, it is neither debt. So what happens is that every InvITs or REITs have a certain assured cash flow, whether it is in the form of rental for any mall operating company, a company which has got a portfolio of mall, they are earning rental from the that mall property, or somebody who is having an or commercial offices, they are earning rent from that, or for that matter, a PG which is earning rental in the form of transmission network which they have already laid out, right? So that the assured cash flow out of that they are paying to the investor in the form of dividend, what we can say. So what is happening? It is like a you can say a kind of a product where you get a fixed cash flow every quarter or every year, where the average pre-tax yield or return is in the band of 6 to 7%. So it is very similar to FD, but the only difference over here is that since the shares are listed, it price keeps on moving up. So in case there is a probability that the overall cash flow is likely to go up by 4 to 7% over the next year, and that can be because if suppose there is an mall rental company, they go on and increase the rent every year or every 3 year, right? To that extent, their cash flow will increase. Or for that matter, assume that they are operating right now at 90% occupancy, and due to increase in demand, the occupancy goes up to 95%. So that can again further lead to the increase in cash flow. So what the company will do because of this increased cash flow, they will pass on that benefit to the shareholder in the form of dividend. So in that case, your yield will jump from either assuming earlier it was 6 to 7%, it may go to 7 to 8%. So because of this increase in yield, there will be an increase in demand for the share. People will go and try to buy that share in the lure of getting a very good yield, and to that extent, there is a probability that you may get some appreciation in the stock price also. So compared to FD, you get slight appreciation in the form of stock price movement, which can be either on the negative side or positive side. On the other hand, you get cash flow in the form of dividend. So it's a quasi equity product. So there is the next question is from Gunjan. Any opinion on online gaming companies? So Gunjan, there are very few online gaming companies which are available in the Indian equity market. One is Nazara and another is the Delta Corp. So again, what has happened is that the online gaming ecosystem in US, or for that matter China, has evolved, where people are willing to pay subscribe to the packages or various cheat code, and that lead to the a lot of earning for the online gaming company. But ultimately what I believe is that you need to have one of the blockbuster game in your kitty to make a extraordinary return from this business. And a case in point, Pokemon was one of the game which caught the fancy of many youngsters across the world. So one sorry, not Pokemon, my apology, PUBG. It was a PUBG game that caught the fancy of the youngsters across the world, right? So one such game can change the fortune of this company. So it's a very event specific approach. However, this the world is expecting that the very similar to US and China, Indian gamers will also start paying money to subscribe to the packages or buying various tools or so on and so forth. So again, very limited options available in India. One is Nazara and one is Delta Corp, but it's a very long term story. I don't know. I mean, whether Indian companies will able to make any game which where it will catch fancy of the global gaming industry. So let's see. I would like to take exposure to this industry in a very small form. Maybe 1 or 2% of the portfolio is the right allotment at the current juncture. Keep on tracking these companies in case they are able to deliver a profitable growth. Then in that case, we can keep on adding the position in those companies.
So next,
In terms of ratio chart, Vinayak, if
yes,
you can help
yes, yes.
how to upload this ratio.
Srinivasan, I would like to show my screen with you to understand how to draw the ratio chart. Angelica, please add to stage. Thank you. So in the this is a trading view window. You can just you have to click here, Nifty. Now I will draw the ratio chart of Nifty Financial Services versus Nifty. Nifty Financial Services divided by, just you just have to type divided by Nifty. You will get the ratio chart, and the ratio chart generally you have to see in line chart format, so it will give you a clear picture. So it is very easy by using ratio chart. Prashant is asking, sir, please tell when to exit the position. So Prashant, if you are holding the short-term positions, I will recommend you use the momentum indicators or trend indicators like moving averages. If you use the exponential moving average, if you are short-term trader, the trader or investor, then I will recommend you to use the 20 period exponential moving average. If your stock's price is slips below the 20-day EMA level, then I will recommend you to exit the position. And if you are holding the long-term positions, if you are investor, then I will recommend you to maintain hold with the stop loss of 200-day EMA level. If the stock is slip below 200-day EMA, then you should exit your position. So Divya is asking, what about US market, especially quantum computers? So the first, I would like to give the idea about the overall US market. So if we see the overall chart of S&P 500, it has witnessed a sharp correction, and thereafter it has from the recent low of 5,504, it has slid into the period of consolidation. So if you see the overall trend of this index is still bearish, and it is unable to surpass its 200-day EMA since last couple of trading sessions. So I will if the index is sustains above 5,700, then we will expect the pullback rally up to the 5,800 levels. And on the downside, if the S&P 500 is slip below 5,590, then we may resume the downward journey for the short term. And if we talk about quantum computers, so if we see the short-term trend, short-term as well as long-term trend is bearish of as this stock these stocks. If you are holding the short-term position, I will recommend you to maintain the stop loss of 6.20 level. On the upside, the 9.20 is the crucial hurdle for this stock. If it is sustains above this level, then we can witness the pullback rally up to the 1150. So, Sunny sir, next question is what is about acceptable debt to equity ratio in the banks?
Yeah, so coming to banks, ultimately one has to keep in mind that banks rely on depositors' money in terms of source of funding. So on one hand, they try to mobilize money in the form of deposits from a retail customer like you and me. On the other hand, they also rely on CASA ratio, which is predominantly current account flow, so which are being maintained by corporates, right? So these are the basically predominantly the major source of funding for banks. And during the some mismatch in terms of liquidity, they rely on other debt instruments. So to match that liquidity, they will do some short-term funding in the form of liquid instrument or something. So what I feel is that for bank, the debt to equity ratio is not very important. But still, in case you want to track that ratio, I believe any bank won't go above 1 or 1.5 times debt to equity ratio. So debt to equity ratio is more important from an NBFC perspective. So most of the non-banking financial services company, they won't be a deposit taking NBFC, right? So they have to rely on external source of money. So that source can be in the form of commercial paper, that can be lend borrowing from the banks, so on and so forth. So those borrowing is one of the important aspect on the balance sheet of non-banking financial companies. And in that case, we believe that that ideal debt to equity ratio should be 4 to 5. So if you see, whenever non-banking financial services company hits the debt level of 4 or 5 times debt to equity, they will try preparing for a next round of fundraising from equity market, so that they keep on increasing their balance sheet size in terms of equity. So that again leads to a reduction in debt to equity ratio. Then again go on to increase the debt. So that's the cycle which NBFC usually follows.
So Suvendu is asking, what is your expectation for market on April? So I would like to show it on a chart. Angelica, please head to stage trading view window. So, Andrew, if we see the current chart structure, the Nifty has witnessed a sharp upside rally of 1400 points, or just 6% in just 13 trading session. And along with this, it has surged above its short-term moving average, that is 20 and 50. And these averages are started edging higher, which is a bullish sign. Further, if you see, it is currently oscillating near its 200-day EMA level, and if it is sustains above this level, then we would it may test the 23,800 level in the short term. If you see the momentum indicators, they are also suggesting the strong bullish momentum in the market. And if you considering the other sectors like Nifty Financial Services, Nifty Private Bank, they both are in a strong uptrend, and these two sectors are holding majority of weightage in the Nifty index. So considering these factors, the we believe that the Nifty and apart from Nifty IT, all the other sectors are also showing strong bullish momentum in the short term. So we expect that the next couple of trading session, the market is likely to witness a positive momentum, and 23,800 is the crucial resistance for the market. If the market sustains about 23,800, then we will witness the extension of upward rally up to the 24,200 level.
Yeah. So, Vinayak, there are some questions on US equity markets also. So, Divya and Robin, they have been asking us question on quantum computers,
Yes.
NVIDIA, Meta, Baba. So, my apologies since we don't have a very detailed coverage, or we are not tracking all these companies. It will be wrong on our part to share view on all these companies. So, it's better to avoid any comment on all such companies which are based out of India, whether it is US or any other equity markets.
Rohit is asking, sir, what is trend of chemical market in the monsoon season is
What is the
coming soon?
trend of chemical market in the monsoon coming with the monsoon season coming soon? So yes, during monsoon, usually what we see is that agrochemical as a sector tends to do well, and few companies which we like among the agrochemical sector are basically Chambal Fertilizer, Coromandel International, Dhanuka Agri, and in addition to that, few seeds focus companies like Kaveri Seed. So these are the few domestic focus agrochemical companies which we would like to focus on within the chemical basket, that is an agrochemical as a basket. So the next question is on Mr. Sheikh Akbar. If you have time, can you enlighten on current investment strategy in the large cap for next 2 3 months? Sorry, join late. No issues, Mr. Sheikh. What we feel is that in case you are planning to deploy a fresh fund in the equity markets, it's better to deploy it gradually. Again, within equity markets, we are more bullish on banking and financial services as a sector. So if you look within that, the priority is on non-banking financial services companies like Bajaj Finance, Chola, Shriram, Muthoot, Mannapuram. So these are the few companies, Aditya Birla Capital, which we like among the NBFC space. Banking sector again is very well placed in terms of valuation. So ICICI Bank, Kotak Bank looks good within the banking large cap area is concerned. Auto ancillary is another sector which we like. Again, very selective within auto and auto ancillary. Cement as a sector is looking good, where companies like Shri Cement or Ultratech are well placed. So what we will do, we will share this presentation with you all, so you can get in touch with your relationship manager, and they can reach out to the research desk for this presentation. The next question is from Kaustub. What is your view on Sula Vineyard? So, Kaustub, yes, Sula has been going through trouble of late, and the reason for that is that during the time of IPO, the street was very bullish on the growth prospect of Sula Vineyard. So, entire wine industry is at a very nascent stage of growth in India. But however, unfortunately, the company has not been able to deliver a very exciting growth in terms of sales and profitability, and that is the reason we are seeing a continuous downtrend as far as Sula Vineyard is concerned. Again, they are the market leader as far as wine segment is concerned. So what I would suggest is that at a current juncture, better to stay on a sideline. Let us review the one more quarter performance, because post correction now, I feel that all the negatives are already in the price, and it's better to wait, hear out to the management in the upcoming result season, and then take a call whether this company is like to deliver a healthy growth over the period of next 2 years. In case they are not able to confidently give any guidance in terms of growth, then we can exit and move on to a better name in a liquor industry like Radico Khaitan or United Spirits.
I would like to add technical part also in Sula Vineyards.
Yeah,
If we see
please.
the technical chart of this stock, it has marked the high of 700, and thereafter it has started marking the sequence of lower top, lower bottom. Currently, the stock is in a strong downtrend, and if we see, it has recently marked the low of 249, and thereafter witnessed a minor pullback. But if we see the volume activity, it is still not much attractive, and the overall trend of the stock is still bearish. So, if you are already holding the position, I will recommend you to hold with the stop loss of 260 level. If the stock is slipped below 260, then I will recommend you to exit the position for short term.
So thanks, Vinayak. So next question is on IndusInd Bank and Asian Paint. Coming to IndusInd Bank and Asian Paint, what I would suggest is that although the valuations have turned attractive post correction in IndusInd Bank, but one has to keep in mind that bank is a very riskier business, and we have seen the earlier cases of Yes Bank, RBL, where even an iota of some misgovernance on corporate governance front, that can lead to a appointment of a special nominee from RBI. And there was some development that there was some rumor floating. I don't know. I have not checked it. That the recent MD may be asked to step down, and there may be some another person who will be running this bank because of this misreporting on derivative position. So I would like to avoid at a current juncture. Better to stick to a better quality names as far as banking sector is concerned. And coming to paint industry, again, very we have seen a very aggressive competition in the entire paint as a sector. Although you are right that lower crude oil prices can help them in mitigating margin pressure, but the competitive intensity is significantly high, whether it is from JSW Group or Birla Group. So again, I would not like to bet on a sector where there is a heightened competitive intensity. Why to go in such sector? Better to stick to companies which are outperforming and are delivering better growth. So Rohit is again asking on Sula Vineyard. So we have discussed this question already. Mr. Suendu, how tariff war will impact our market in short term? Can we go for buying long-term investment? So what I would suggest is that the clarity will emerge, likely to emerge in the first week of April, when US is going to hand over the various tariff sheet to all the countries. So let us wait. I think it's not going to be very easy for the entire global economy to all of a sudden start exporting goods at a very high rate to the US. Ultimately, it is the US consumer who will be the decision maker whether they want to buy these goods or services at an higher rate, or they would like to postpone their own consumption of that goods or services, right? So I think it will take some time for clarity to emerge on that. So let us wait. Let us wait at least for the first week of April to get more clarity on this aspect. So there is the next question from Kaustub. Would like to understand, if somebody want a regular return from IDCW mutual fund, can there be any strategy followed for the same? So Kaustub, what I would suggest is that kindly get in touch with us. So there is a dedicated a team in our TPP distribution, so they can help you with your query on this. But nowadays there is a lot of fad that you invest certain money in the balance advantage fund, and then you try to withdraw close to 3 to 4% of that amount on an every year basis, assuming the return of 6 to 8% after certain 10 20 years, you will still be left with a lot of corpus, and you can generate a decent monthly return. But one has to keep in mind that all these assumptions are based on a basic premises that that fund will continue to deliver return which is higher than your withdrawal rate. So if your withdrawal rate is 4 to 5%, and if your fund is delivering return of 10%, obviously over the period of next 10 20 years, even if you keep on withdrawing 5% of your corpus, your basically the corpus will remain intact, and in fact it can deliver a very good return. But imagine a scenario in case your fund is unable to deliver the return which is equivalent to your withdrawal rate, or it is lesser than that. In that case, that theory will fall. So I think there are a lot of ifs and buts involved in all such kind of computation and calculation. So I would request you to get in touch with us for a detailed computation of the same. Again, next question is from Uday Kumar. In this market, JSW holding, is it at lifetime high? Why? Udayji, I need to get into deeper understanding of this, but I would like to just give a very brief understanding on that. So, if you see, most of the holding companies are trading at 60 to 70% discount to the fair value. And what I believe is that within JSW holding, I need to check that their new, if you see of late, JSW as a group has become very aggressive, right? So, they have ventured into paints, they have ventured into automobile business like MG Hector, wherein they have acquired the MG Hector, and at the same time, a whole lot of businesses they are venturing into. So I believe that JSW holding might be at the same time. Cement is the one a big sector where they have went very aggressively, and they are likely to come up with an IPO of a cement company also. So I need to check whether JSW holding has got some equity in the cement business. In case there is some equity of JSW holding in cement business, though the street is getting excited that because of this listing of cement business, there can be an value unlocking for JSW holding shareholder. So that can be one of the probability. But let me check it, and we will get back to you maybe post this webinar on Monday. So you please be in touch with your relationship manager. Definitely, we will get back to you on this. The next question is from Divya. Is it the right time to buy Tata Motors and Bajaj Housing Finance, or should we wait? So Divya, when it comes to Tata Motors, I would suggest that it's better to wait at a current juncture. Although all the negative is in price at the moment, the stock has already corrected from highs of 11 1200 band to close to 6 to 700 band. But one has to keep in mind that Tata Motors is all about JLR, right? 80% of the business is from JLR, and the way the world automobile ecosystem is seeing a lot of increased competition from guys of likes of BYD Chinese player. So recently there was an announcement that BYD has launched a battery which can charge in the 5 minutes, and that vehicle can run for 400 kilometer. This is very equivalent to refilling your vehicle in 5 minutes. If you are able to get a range of 400 kilometer, the entire automobile ecosystem is, as far as passenger vehicle is concerned, the proposition can change significantly. In fact, BYD has went on to give a very tough competition even to the likes of European manufacturer who has been in this industry since ages, right? So I think a lot of transition is happening in the entire automobile industry, especially on EV side. So better to wait. Let us see what happens over the period of next 2 3 months. Coming to Bajaj Housing Finance, again here I would like to remain bullish as we have discussed earlier. Although it is one of the most expensive stock in terms of valuation, trading at 4 to 5 times price to book multiple. But again, one has to keep in mind that this company will double its loan book every 3 years. If you are growing at 23 to 25% CAGR, your loan book will double every 3 4 years. So if I discount this number 3 year down the line, you are trading at 2 times price to book. So again, a company which is growing at a faster clip will continue to command a higher valuation, and hence Bajaj Housing Finance can deliver a kind of 10 to 15% return in the short term. I will request Vinayak also to add a technical support and resistance as far as Bajaj Housing Finance is concerned.
Yes, yes, yes. If you see the technical chart of Bajaj Housing Finance, it has recently given a breakout of symmetrical triangle pattern, and this breakout is confirmed by relatively higher volume. So also it has surged above its crucial moving averages also, and the momentum indicators are also suggesting strong bullish momentum. So the major trend of stock is bullish. So I will recommend you can enter in this stock, and it is likely to test the level of 130. 100, if the stock is sustained above 130, then it is likely to test the level of 148 in the short term.
The next question is from Mr. Thomas Matthew. What is the NRI investment as a percentage of total investment in Indian equity market relative as a percentage of total pie to FII and resident investor, either directly and indirectly via mutual fund and ULIP? Mr. Thomas, I'm sorry I don't have this the data handy at a current juncture. But what I can say is that as of now, FII as an overall Indian equity market pie are close to 16-17%. And recently there was a stat that this is the first time where DII, domestic institutional investor, have overtaken them in terms of percentage holding in Indian equity market. So FIIs hold close to 16-17% of that pie. And if I take that in an absolute number, so right now the market cap of Indian equity market is close to 4.5, 4.6 trillion dollar. And if I take 16% of that number, that will come in the band of close to 600 to 800 billion dollar. So that's an overall stats as far as FII are concerned. In terms of NRI, I don't think so. Exchanges report a separate category in terms of NRI as an again a subset of FII. But let me check that data, and probably in case that data is available, I am happy to share that data with you. I think just a minute. So there are we can take a last few questions. So again, Jindal Steel and Power at a current valuation, is it a good buy? So Jindal Steel and Power again, I feel that of late promoters have been buying aggressively in this company. So overall, as discussed earlier, the metal sector continue to look good. And coming to specifically to the Jindal Steel and Power, because of this likely imposition of import duty on anti-dumping duty on import from China or any other country, we believe that the steel player can report a decent earning growing going forward. Power as a sector also, I mean, continue to look good. So I would request Vinayak to share support and resistance for JSPL.
Oh, see, Jindal still has witnessed a pullback rally after testing the level of 723, and currently it is trading above its short-term and long-term moving averages. However, the momentum is not stronger. So the for the short term, 944, no, 945 to 950 zone is the crucial hurdle for the stock. If it is sustainable 950, then it is likely to test the level of 1010 in the short term. And on the downside, if it is slips below the 880 level, then it is likely to witness a correction up to the level of 840 followed by 810 level.
Yeah, thanks, Vinayak. The next question is, please share the model portfolio. So, Pratapji, I will request you to please drop in your request through your relationship manager. We will share the model portfolio with you. Next question is from Mr. Varghese. IDFC First Bank has not performed well. When do you think IDFC First Bank can pay the dividend? So yes, I agree that IDFC First Bank has been going through the pain, and the key trigger point during the September quarter was all of sudden stoppage of basically toll on all the entry points of Mumbai, and one of the client of IDFC First Bank was generating income from that. So since because of that stoppage of incoming vehicle or outgoing vehicle from Mumbai at Mulund Cheknaka, so there the bank has taken an provision of close to 200 to 50 crore, and that was the reason that IDFC First Bank asset quality deteriorated at that point of time. If I go by the bank's commentary, I think it will take another 1 or 2 quarters for bank to be on a growth path. But again, being a young bank, a technology-driven bank backed by the very strong promoter, I feel that the overall IDFC First Bank has got a very good future. So let us, we need to have patience if somebody is already invested in IDFC First Bank. Let us see what happen in this upcoming quarter. In case there is some bullish commentary for fiscal year 26 and 27, then we can expect some recovery in terms of stock price. So I think we can take last few question again. My investment is down 20% in Birla Corp and Natco. Should I exit or hold? Long term perspective. So, Mr. Subhash, what I would suggest is that I agree that Birla Corp is have corrected significantly, and that was because the entire cement sector was going through pain. What I would suggest is that continue to hold as far as Birla Corp is concerned. We believe that cement as a sector is likely to do well in medium to long term. So Birla Corp, I would suggest to hold. In terms of Natco, so there was an negative surprise as far as Natco is concerned that the Revlimid, which was one of the blockbuster drugs, so they are short of that, and hence that will hit their earning. So in terms of Natco, I would suggest you to be a little bit cautious on Natco. In fact, I would recommend you to exit from Natco and shift to a other better name. Vinayak, if you can suggest some stop loss level or the levels where one can exit from Natco and shift to other name.
So if you see the Natco Pharma chart, if it is trading in a consolidation zone, the overall trend of the stock is a bearish, and I will recommend you to exit if it is slips below the 780 level.
Yeah, thanks, Vinayak. I think, I mean, we have addressed almost 99% of the question. In case we have missed any question, please feel free to reach out to research desk through your relationship manager. We will be more than happy to address any query and look forward to your support. And once again, thank you for joining us today evening for this program. And good day ahead. Thanks, Vinayak. Thanks, Angelica.
Thank you. Thank you, sir.